I'm Oliver Rennick.
I'm Julie Hyman.
And I'm Scarlet Fu. Joe Weisenthal is off today.
Global equities headed toward their longest monthly advance since June 2014.
But the question is, what'd you miss? After a relatively calm summer, volatility increases at the end of the third quarter. We highlight the biggest moves and look ahead to the final 3 months of 2016.
Plus, Deutsche Bank rebounds from a record low on speculation that it may reach a lower settlement with the U.S. Department of Justice.
And Citigroup's global head of commodities research, Ed Morse, tells us why he's not changing his forecast after this week's OPEC deal.
We begin with our market minutes. The Dow up almost 200 points. And, of course, the S&P 500 gaining to end higher for the week. It was a bit of a toss-up which way we would end, but it does look like it's a positive number for the week. This was the Dow's best day since September 12th. And within the different sectors, I'm looking at financial and energy, those two groups leading the gains in the S&P 500.
You know, it wasn't a bad week in terms of volume. You basically had an average of about 7 billion shares traded, which is pretty good, all things considered. I'm going to jump into what happened specifically in the stock market today, looking at a couple sectors that were the winners and the losers. Let's start with the losers because there was only really one group that was down a major amount, and that was the utilities group. I thought this was interesting because if you look right below it, the staples still gained about 94 basis points. So a little bit of a diverging story in terms of the higher yielding stocks. Utilities there are much more subjected to the yield play. So that's kind of interesting as we see those break down. Then you have the energy companies doing pretty well. This has been a big part of the market that has come back into play as we watch commodities and oil get a little bit more volatile, and post-OPEC deal, a little bit of gains here, and the energy sector is contributing to that. Then if we take it over to the next board, looking at what happened on the week, this is obviously the story of the week. I mean, you can't talk about the markets, any markets really, whether you're looking at bonds, stocks, or anything, without talking about Deutsche Bank and the financials group. Solid rebound, solid rebound overall from Deutsche Bank, which, of course, beyond just the news after the DOJ fine, the stocks have been going down for a long time, but a little bit of relief. Financials group still ended in the red. A lot of that is still tied to rate expectations as well. And overall on the week, Infotech was pretty boring. Tech stocks have been doing really well, and they just kind of faded this week. So we'll see if they come back.
Still up, though.
Yeah.
And you mentioned twice rates and the effect they had on stocks, because the utilities and financials also both keyed off of rates to some extent. Today, you saw a little bit of a rebound in yields. That's something that generally has been on a downtrend here. The 2-year yield up 3 basis points, 0.76%. The 10-year, 4 basis points to 1.6%. So today, yes, of course, you had the Deutsche Bank effect, but you also had the bump up in yield, something that was a little bit of a relief for the financial stocks and also hurt the utilities conversely. If you look at the month and what we have seen for rates, it's been interesting because it's gone nowhere when all is said and done. Yes, you had a rise in rates mid-month. We heard from the Fed. We got the indication that we could get a rate increase, but not until December. So then a drop once again coming out of that meeting, and only a 2 basis point increase overall in the month. 1.6% is where we end.
But what a wide move it was during the month. All right, taking a look at currencies, of course, we had some relief on the Deutsche Bank front. There was also an encouraging inflation report in Europe that showed inflation in the euro area picked up in September to the fastest pace since late 2014. So we saw the euro gaining versus the dollar. Also worth noting that the euro gaining versus the Swiss franc on speculation that the Swiss National Bank may have intervened, selling the franc to reduce its strength. But the SNB spokesman declined to comment on that possibility. I also included the rand there just to show that it is firmer in line with that risk trade. For the week, though, the focus has to be on the Mexican peso, up 21% versus the U.S. dollar, or I should say up 21%. It is the best performer versus the U.S. dollar. There's the gain, of course, the U.S. dollar has made versus the Mexican peso, or the loss, I should say. The peso had slumped as Donald Trump's odds of being elected president increased, but the perception that he didn't win the presidential debates on Monday sent him lower in the polls, and, of course, that boosted the peso as a result. Quick mention, too, that Mexico's central bank also raised interest rates this week to make it more expensive for traders to use the peso to hedge risk out as well.
It's true. We kind of overlooked that because we had all that Deutsche Bank news breaking, but important to remember to see what kind of action they take to try and sort of stimulate what's been happening.
Right. Of course, that would help the peso, too.
Yes, absolutely. And, of course, the peso is tied to commodities, so we got to mention commodities here. First, though, a quick look at corn prices for the day. They headed for their biggest gain in 2 weeks. There was a U.S. government report that showed stockpiles trailed analyst estimates. But here was the big mover. For the week, of course, oil prices moved around, and the big news was that OPEC members managed to leave Algiers with an agreement to cut production. That happened mid-Wednesday. Neither WTI nor Brent really surpassed 50. You see that Brent is at 50, but they do finish the week higher. So we finally got to that $50 level for Brent crude.
Thank you, OPEC.
Those are today's market minutes. Let's take a deep dive now into the Bloomberg. You can find all the charts using the function at the bottom of the screen.
So for my deep dive, I want to look at Treasuries and what we saw for the third quarter for Treasuries and what might be to come as well. So this chart is #BTB3933, and I'm looking at Treasuries over the course of this year thus far. So if you want to look at the third quarter in particular, you have it from here to about here. So generally, there's been to here. So generally, there's been an uptrend in Treasuries over that period of time. But I have these yellow dotted lines on here because there is such a divergence now in terms of where we're going next. What are central banks around the globe? What is the Federal Reserve going to do? So on the one hand, you have Goldman Sachs predicting a year-end 10-year Treasury rate of 2%. On the other hand, you have Morgan Stanley looking for 1.25%. So there's just an extraordinary amount of uncertainty out there right now, and disagreement and debate among different banks, among different investors and strategists about what is going to happen. And a lot of it hinges on the Fed, obviously, but also what is the state of the U.S. economy? Is it healthy? Is it not healthy? And the data has just not been conclusive enough one way or the other for these economists to really make a very clear prediction.
You know, the divide kind of mirrors what's happening inside the Federal Reserve as well, with those three dissenters at the last FOMC meeting.
Definitely.
All right, well, I'm taking a look. Actually, you know what, Oliver, you're next, right?
Sure, let's go with some more forecasts. I like that. And I love that chart because as journalists, we love to, talk about when, major strategists diverge from one each other's opinion. But there's so much at stake there because we know that markets have moved together. We know that stocks and bonds have moved together. Where that 10-year goes is going to be important, not just to, holders of treasuries. I'm going to jump in and look at the holiday rally. It's a little bit early, but let's talk about Christmas because stock investors know there's this sort of seasonal rally that typically happens at the end of the year. Your last 3 months of any year since 1970 are the best for stocks, and since the bull market started, your quarterly return in the fourth quarter is twice the next best quarter. But if Wall Street strategists are to be believed, that's indicated by the blue line here, guess what? We're not going anywhere. Their end-of-year forecast is 2171, and where we're trading right now is basically at that level. So right now, of the 19 strategists that we survey at Bloomberg, they're predicting the market to go pretty much nowhere. And the reason why this is noteworthy is because if I take this back 5 years, that blue line, 82% of the time it's above the white line, meaning that 82% of the time strategists for the past decade actually have predicted that the market is going to go higher than its current level. So this is also despite some of the recent upgrades by some strategists after the Fed chose to hold rates where they were, but it wasn't enough to put their estimate much higher. So if you put a lot of weight in that, then markets are going to have a pretty flat line from here.
Well, from here,
right, but
still an increase on the year.
Exactly. And then 2017, we've only got about 5 estimates right now, but they are predicting the market to get to closer to 22.5, 2,300. So all hope is not lost.
All hope is not lost. Well, we've covered bonds, we've covered equities. So let's take a look at commodities as well. When you looked at commodity ranked returns, this is the CRR Go function on the Bloomberg. You'll see that nickel was the second best performing metal this quarter, up about 12%. And actually up until today, it was the best performing metal. Zinc kind of overtook it in the final day. Only orange juice and sugar did better. Actually, you know what? I'm going to correct myself. Lead did better than both of those. So there you go. Nickel, though, trading at around a 6-week high right now after an unexpectedly stringent mining audit in the Philippines, which is the top ore supplier. Apparently, 3/4 of the Philippines mining industry essentially failed an audit. So nickel mines are being shut down around the country. 20 more mines could be shut down in the coming days. That tighter supply has led to higher prices for the metal. And according to Citigroup's David Wilson, prices could reach an average of $11,000 per metric ton in the fourth quarter from the current $10,575. And by 2017 could reach $11,700. So something to watch out for.
Yeah, we have some headlines coming across from Viacom, and this has to do with National Amusements' offer to, remember, combine Viacom and CBS. That is the company, the holding company of the Redstone family. So the Viacom board has now said it has formed a special committee to evaluate that National Amusements request. The request, again, was for CBS and Viacom to evaluate a combination. So the Viacom committee now is going to do this, and it looks like comprises the various board members here. Obviously, this is an unusual situation that we've been talking about since the Redstone family controls all of the companies involved, but there are other shareholders involved as well as they try and figure out whether indeed they are going to get together here.
All right. And of course, they're also adding some independent directors, or this committee is made up of independent directors, including Thomas May and Nicole Seligman. So we'll continue to keep you posted on any developments there. Coming up, it's been a roller coaster ride for Deutsche Bank after questions about its capital alarmed investors. We're going to explore the impact. This is Bloomberg.
I'm Mark Crumpton. Let's get to First Word News. Officials say the investigation into Thursday's deadly train crash at the Hoboken, New Jersey station could take at least 7 to 10 days. National Transportation Safety Board investigators have recovered the event recorder. They're hoping it will tell them how fast the NJ Transit commuter train was going when it smashed through a concrete and steel bumper and into the train station. One person was killed. More than 100 others were injured. Hillary Clinton's campaign hopes to enlist 5 million millennials in a national service reserve. Members could be called up to serve in emergency relief and natural disasters. Secretary Clinton told a rally today in Florida that there's also an issue concerning student debt.
I believe one of the jobs of the president is to encourage more service, to help more Americans answer President Kennedy's call. You know it. Ask not what your country can do for you, but what you can do for your country.
Secretary Clinton has struggled to attract overwhelming support among young people. This week, she turned to former rival Bernie Sanders in an effort to connect with millennials drawn to third-party candidates. The Commission on Presidential Debate says there were problems with Donald Trump's audio during the first debate on Monday night. According to a one-sentence statement on its website, the commission writes, quote, "There were issues with Donald Trump's audio that affected the sound level in the debate hall," end quote. Trump had said following the debate that his microphone was faulty. The United Nations Human Rights Council has voted to convene a high-level panel to discuss human rights in Syria. The resolution passed by a vote of 26-7 with 14 abstentions. It calls for a panel to discuss issues like enforced disappearances charges and arbitrary detention and the need for accountability for violations and abuses in Syria. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Julie?
Thanks, Mark. It's been quite a ride for shares of Deutsche Bank. Yesterday, Bloomberg reported that some hedge fund clients had reduced their financial exposure to the bank, sending shares to a record low. But then today, the stock recouped some of those losses after a report that a settlement with the Department of Justice may be smaller than expected. Our guest this week weighed in on those developments.
I think we live in an environment of zero interest rates. Banks are in pretty good shape, not great shape, but good shape. Earnings power is pretty good. And I think Deutsche Bank really was a liquidity concern that, is being alleviated today because of the potential settlement.
Now, certain newspapers are reporting that settlement might come quite soon. I don't think so. The Royal Bank of Scotland have been trying to negotiate theirs for about 3 or 4 years now. I think the most important thing is to look at the overall balance sheet of Deutsche Bank, 215 billion of liquidity. Again, as I said, there's questions over capital, but I think its ability to service itself, at the moment, it's very sound.
If you look at it as an actual credit risk, is it about to go bust? Sorry, not at all. They changed the law in Germany. 60 billion of senior debt is there to become, it comes before any of the business creditors or depositors. That effectively means there's 60 billion, which in a crisis becomes equity, and that's more than enough for Deutsche Bank to be healthy for a long time to come.
Deutsche doesn't have any issues right now, but it's just the problem is the more people keep talking about it, the harder it becomes, right? And the more they'll keep saying we don't have issues. I actually don't think they do, but it's hard. It's hard for somebody to be levered that much. You can't withstand shocks.
For more on Deutsche Bank and on the broader markets, we're joined by Bloomberg Gadfly columnist Mike Regan. Mike, a confidence issue, as they were talking about. And yet here we have person after person saying it's not a real issue, it's not a real issue, it's not a real issue. But that's not how the stock has been performing, right? That's not how overall the financial stocks have been performing.
Right. I think it was Matt Miller who coined the phrase lizard brain. There's this part of your brain that reacts to certain things, and it doesn't necessarily make a lot of rational sense. But when you see a word like collateral in a headline cross suddenly in the middle of the day, it just takes you back to 2008 when, the U.S. investment banks were having a lot of problems with clients pulling collateral. And as all those guests said, Deutsche Bank has liquidity, plenty of liquidity to stand this. But liquidity can evaporate pretty quickly in times of stress. And to a lot of U.S. investors, I think Deutsche Bank's a big black box that they don't quite get, as is the whole European financial system. All of the regulatory changes, the contingent convertible bonds. For U.S.-focused investors, it's kind of been something they've sort of watched passively go by and not really focused on. And when you see that sort of alarming headline that hedge funds are pulling collateral, it's kind of a sell first and ask questions later type of thing. Obviously, even today when everyone woke up, there was a bit of a rebound. Then we heard the report that the settlement, basically we've been calling it a game of chicken, a three-way game of chicken with Deutsche Bank. On one side you have, the German government blink and bail them out. On the other side, will the DOJ blink and lower the mortgage settlement. And, luckily it looks like the DOJ is the one that's blinking. And they announced it at the right time, or at least leaked, it leaked to AFP at the right time. And with any of these news stories, it's interesting to see when a piece of news breaks like that. Sometimes it's debunked 10 minutes later. Sometimes it's confirmed 10 minutes later. Here we go to the end of the day, and neither debunked nor confirmed. So I guess that's a positive sign that at least it wasn't debunked.
Well, the fears with Deutsche Bank kind of persist because of what happened earlier in the year, right? I mean, the stock had tumbled to a record low back in February on concern that it wouldn't be able to make payments related to its cocoa bonds.
Right.
So there was something familiar with this Deutsche Bank story. The liquidity issue is certainly one that's front and center, but the near-term issue of the settlement with the DOJ is what started this selling for this week. But underneath it all is, where's the earnings going to come from for this bank, even with all these legal provisions that it needs to make? Where's the growth strategy?
Absolutely. How does a bank make money in a negative interest rate environment? There's a lot of sort of rethinking of all these European policies, and even, there's a big backlash against the continued low rates in the U.S. And, that's the longer-term story for Deutsche Bank. How do they sort of get out of this funk with negative interest rates? And I don't think anyone has a good answer.
Is there a way to kind of separate the woes associated specifically with Deutsche Bank and those, as you kind of just hinted at, which are the larger issues that have been kind of overhanging all the financial stocks in banks in the U.S.? I mean, because you look at the banks and they're kind of unchanged on the week. It doesn't seem like people are really kind of projecting that onto the rest of that sector.
Yeah, I mean, it was basically this knee-jerk reaction yesterday, and people trying to figure out, well, what would this contagion look like? But yeah, long term, I mean, the earnings outlook is not super robust. That said, if you look at the massive rebound in banks since the Brexit. Bank of America is up about, I think, 18-19% in the quarter. So they've recovered, but they've sort of plateaued a little bit. And obviously, people have been waiting for interest rates to rise for a few years now, and it just keeps, it's like Charlie Brown, the football keeps getting moved away from him. Good thing for bank stocks, obviously, this week was Janet Yellen coming out and sort of laying the groundwork for a December rate increase. I feel like all of the stars aligned for the market this week. The OPEC agreement is sort of put the floor under oil prices. Deutsche Bank was somewhat resolved by the end of the week. And even on Monday, the debate kind of sucked a little of the momentum from the Trump campaign and got people back to that certainty on the election that they had before that momentum took over.
And I've also been looking at the numbers for the quarter. So if you want to take a look at the Bloomberg here, I've got the various groups and how they did this quarter. Tech was the big leader. That's a theme we've been talking about. Up 12% on the quarter. As we mentioned earlier, Amazon just keeps hitting record high after record high after record high. Financials actually number 2.
Oh, that's surprising.
Even though the football keeps getting moved, there's still the hope there. Charlie Brown always hopes, that it's going to be there. So overall, we saw a 3.3% bump in the S&P 500 this quarter.
Yeah, and you can tell, obviously, a rotation. We've been talking about it all quarter, so not to sound like a broken record, but the rotation out of the high dividend stocks into financial. I mean, again, Brexit does kind of, if you're looking at this quarter and trying to dissect it, Brexit does kind of change the picture a little bit, because the bank stocks, even though the market pretty much had recovered right by the end of June, bank stocks took a little bit longer to recover. So that's partly reflected there, is that continued easing of concern over Brexit. But the tech story is really amazing. I mean, it's deja vu. We're talking about those 4 horsemen again: Apple and Alphabet, Microsoft, Intel, Amazon. Apple up 18% in the quarter. I mean, that's about 12%. 10 or 12% of the S&P move right there, with iPhone 7 fever going on. Yeah. So, it's back to that story again.
It's amazing. As soon as Apple comes into the picture, we start talking about tech again, because it's just so big for the market. Yeah. Mike, thanks so much. Wrapping up the week and the quarter in stocks. That's Mike Regan. He's a Bloomberg Gadfly columnist. For more fast commentary, go to GADF Go on the Bloomberg.
Coming up, Julie has a chart on the bacon, egg, and cheese index that you can't miss. This is Bloomberg.
Julie Hyman. What'd you miss? Well, we're talking about food prices that have been falling. Bloomberg News' Craig Giammona pointed out in a story this week that it has been 9 straight months. So we have seen a decline in the price of food at home, groceries, in other words. So this is the rate of change for this particular urban consumer food at home index. And so anything below the white line is a negative reading. So it has indeed been 9 straight months that we have seen that change. We've seen a decline in food prices, a lot of components, in particular that promised bacon, egg, and cheese index. Our Dan Curtis came up with this, looking at the proportion of bacon, egg, and cheese in a bacon, egg, and cheese sandwich.
This is incredible.
Which is pretty amazing. And so, obviously, you see a decline there in that particular index. So we have seen all these component parts on the decline. Then on top of that, you have basically a price war among grocery companies. So you have food prices falling, you have oil prices falling, so transportation costs, and then you have some of these lower cost grocers like Aldi that have come into markets where they weren't before. Then you have the giants like Kroger cutting prices. You have Walmart in the mix, obviously, and all of that has equaled, despite what seems like a pretty fraught consumer environment, but it's getting cheaper at the grocery store.
Don't forget, you also have Whole Foods coming in because they're on this big expansion plan. And of course, they're coming in. They have to make sure that their prices aren't too high either. So they're in there mucking it up as well.
Right. They've got this new 365 concept, store concept, that's smaller format in urban areas that's also going to focus more on value.
Man, I feel like I'm killing all the fun right now. As essential as bacon, egg, and cheese is to my life, I'm going to switch it up and look at market stuff. I'm going to look at shorts. Well, I guess that is market stuff. I'm looking at stock stuff. This is a bit of diverging opinion in 2 different parts of the market here in which you can bet speculatively on where the S&P 500 is going to go. The white line here shows short interest, the average short interest moving down, a little bit of a tick up. But overall, we are down from the highs earlier in the year. But at the same time, if you look at positioning, it's increased quite a bit. So you have to try and figure out, this is right here looking at volatility skew. So the higher it gets, you're betting on markets going down.
Huh.
Yeah,
right.
So a little bit of divergence there.
A little divergence. Julie mentioned food prices declining at home. Well, what about inflation? The Fed faces a delicate balancing act when it comes to inflation. We'll weigh all the factors the central bank needs to consider. This is Bloomberg.
I'm Mark Crumpton. Let's get to First Word News. A new ad from Donald Trump is seizing on recent comments Hillary Clinton made, questioning why she isn't further ahead in the presidential race. The ad uses footage of Clinton asking, "Why aren't I 50 points ahead, you might ask?" It then references FBI criticism of Clinton's use of a private email server while she was Secretary of State. Trump's campaign has been dramatically outspent by Clinton's when it comes to ads. A Homeland Security Department official tells the Associated Press hackers have targeted the voter registration systems of more than 20 states in recent months. In August, the FBI warned state officials to improve their election security after hackers targeted systems in Illinois and Arizona. U.S. officials say election systems are generally not connected to the internet, making it harder for hackers to alter election outcomes. In Jerusalem, a somber goodbye today to former Israeli Prime Minister Shimon Peres. He died this week at the age of 93. He had won the Nobel Prize for helping negotiate an historic peace treaty with the Palestinians. President Obama was among the dozens of world leaders in attendance.
I could not be more honored to be in Jerusalem to say farewell to my friend Shimon Peres, who showed us that justice and hope are at the heart of the Zionist idea.
Peres will be buried next to another Prime Minister, Yitzhak Rabin, who was assassinated in 1995. 6 people have been killed in landslides triggered by a major typhoon that lashed southeastern China. More than 23 people are still missing. Typhoon Magi brought torrential rain and strong winds into parts of southeastern China and Taiwan, destroying hundreds of houses and shutting down airports and railways. 5 people died during the storm. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlet, back to you.
All right. Thank you so much, Mark. Let's get a recap of today's market action. U.S. stocks rallying with the Dow rising more than 160 points. You have the concern over European bank health diminishing a bit after AFP reported that Deutsche Bank is getting closer to settling with the DOJ at $5.4 billion as opposed to the initially proposed $14 billion. Of course, this is an AFP report. We have not confirmed it independently.
And in terms of the best performers, financials, yes, were the best performers, but also energy was up there. And energy, I'm just looking at crude oil, WTI up nearly 8% on the week because of that OPEC agreement that was so unexpected by the market, such a surprise. So energy shares really helping things out as well. You know, despite all the hubbub about Deutsche Bank, other than a pop in the VIX, yesterday, there was really nothing in terms of volatility. Volatility is still very low, and we're back below 14 on the VIX. So if you're looking at the U.S. markets, it doesn't seem like we're too concerned about the whole situation. But we'll find out. What'd you miss? Today's key economic number. Core PCE, the Federal Reserve's preferred inflation gauge, advanced by 1.7% in August, another small step towards the Fed's target of 2%. So should the Fed be worried about the rise in inflation? Here's what Philadelphia Fed President Patrick Harker told Bloomberg's Mike McKee in an exclusive interview.
So I think core inflation, PCE, CPI, whatever measure you look at, is moving toward the 2% target. Some of this, when it comes to headline inflation, of course, is related to energy prices and other commodity prices. As we see those firm or increase, we're going to see the 2% target attained. I am convinced we're going to achieve that sooner rather than later, so I am somewhat concerned about falling behind the curve.
Joining us now is Michael Ashton, Managing Principal at Enduring Investments. Thank you so much for joining. You just heard this idea that maybe we're going to be running up on inflation faster than we want. Is there some truth to that? Where do you stand?
Oh, sure. Well, you know, the Fed says that its target is 2%, and that one of the reasons they didn't tighten in this last meeting was because of the persistence of inflation below 2%. But if you look at anything other than core PCE, if you look at core CPI or sticky CPI or median CPI or wages or ECI, you name it, they're all above 2%. So, you know, I think that there's no huge mystery here that the Fed is that core PCE is going to get up to where it's concerning the Fed.
And just to put your words into visualization here, if you want to jump into the chart, this is exactly what you're just pointing out, where if you look at core PCE, core CPI, the bottom three there, core, median, and sticky CPI, all above the 2% line right here in the yellow. What is then, is this where the conversation is about then, this point right here, how to get that up to the 2%? Is it possible using the method that we are right now?
Well, it's funny, the Fed focuses on core PCE, but the difference between PCE and CPI is at its basic level, a pretty simple thing. CPI measures what consumers buy, and PCE measures what businesses sell. Now, what you can see, there's a difference right there, that businesses also sell to other businesses and they sell to government. And so when you look at the difference between CPI and PCE, what's dragging down PCE are things that we don't really buy, differences in the way we're measuring these things.
Historically, though, does PCE tend to be a laggard? Is that what we've seen in the past?
PCE doesn't tend to be a laggard per se, but it does tend to be a little bit below core CPI, about 1/4 to 0.5% over time. And that's, again, there's sort of two main differences. They refer to them as weight effects and scope effects. The interesting ones right now are the scope effects. But, for example, because the government doesn't buy housing, but consumers do, the weight of housing in PCE is less. Well, since housing has been a large part of the CPI going up, it's one of the reasons PCI is a little bit behind.
Do you think, though, that the Fed is sort of misguided in relying so heavily on PCE? Is there some sort of blended measure, for example, they could be using that accounts for both of these?
Well, whether or not, so the reason that the Fed likes the PCE is that it covers a larger part of the economy, not just the consumer part of the economy, but everything. But, of course, the question is whether or not the parts that the PCE is covering in addition, in particular government, does that really respond to monetary policy at all? So one of the big scope effects is the fact that if you look at healthcare inflation in PCE compared to medical care inflation in the CPI, medical care inflation in the CPI, the stuff that that we buy, has been going up. The medical healthcare inflation in the PCE hasn't been, because that's like social Medicare and other things that the federal government buys directly.
That's Obamacare?
Well, Obamacare is probably what's pushing up the consumer part of it. And then, but obviously, in general, because the government spends so much money buying pharmaceuticals and buying things through Medicare, it tends to have a lot more control over those numbers. And so that spread right now is as wide as it's been in a long time. That's a scope effect. We're actually measuring, in both cases, healthcare, but different types of healthcare.
Patrick Harker talked a little earlier about commodity costs bleeding through into core inflation reads as well. When you look at PCE, will a sustained increase in energy prices, for instance, now that OPEC has made a decision to cut production, will that bleed through into PCE, you think?
Whether it bleeds into core, it's always a bit of a conundrum how much energy prices eventually go into core or not. Mm-hmm. And that sort of changes over time. And I don't think that's the big concern. The real big concern, frankly, for me, is that the Federal Reserve, in focusing on PCE, is focusing on a measure that includes a part of the economy that monetary policy can't affect. There's nothing the Fed is going to do that's going to change what Medicare pays for pharmaceuticals. And that seems a little silly to me.
So then what's sort of your conclusion from all of this? In other words, do you then draw an investment conclusion from the idea that perhaps the Fed is not fully capturing what is going on with inflation?
Well, I think the conclusion is, and I've said it a lot of times, the Fed should have begun to unwind its extraordinary policy back in 2011. And instead, they kind of kept adding more and more extraordinary policy. So, the investment conclusion these days always kind of boils down to what's the Fed going to do next, and it's a question of how quickly the Fed figures out that they're behind the curve on inflation.
Before we let you go, I've got to ask you, a lot of people thought maybe there would be a banking crisis in the making this week with all the concerns about Deutsche Bank. If we do get a banking crisis, whether it's spurred by something like Deutsche Bank or something else on the other side of the world, what does that mean for inflation? Does that lead to deflation?
Classically, a banking crisis would lead to deflation or disinflation because it would lower interest rates. and lower interest rates lead to lower money velocity, which leads to lower inflation. But right now you have interest rates that are already at a very low ebb, and so it strikes me as unlikely that we would see inflation. Maybe you see the upward trend level off a bit, maybe go down slightly, but we're not worried about deflation anytime soon.
But still by no means helping the Fed's outlook for inflation.
I think the Fed's on the wrong side of this one right now.
Right. All right, Michael, thanks so much for coming.
Thank you.
Michael Ashton, Managing Principal at Enduring Investments.
Coming up, new polls show that Hillary Clinton has taken the lead in 2 key states as she makes her bid for the White House. We'll explore this post-debate bump. This is Bloomberg. I'm Scarlet Food. It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. GlaxoSmithKline will pay $20 million to settle SEC claims that its Chinese unit bribed foreign officials. The agency says the division gave officials gifts, travel and shopping excursions to increase sales. The drug maker says it's not admitting or denying the findings, but it says it will put anti-corruption measures in place. Subaru is recalling almost 593,000 vehicles, some for a second time. And the reason is because windshield wiper motors can overheat, and that increases the risk of a fire. The recall affects certain legacy and Outback models from 2010 to 2014. Dealers will replace the wiper motor bottom cover at a cost, but a schedule for the recall is not yet finished. And Qualcomm is set to have held talks with several potential acquisition targets, including NXP Semiconductors. That's according to people familiar with the matter. Qualcomm is seeking acquisitions to strengthen its position in a rapidly consolidating industry. A deal could be valued at about $35 billion. And that is the Bloomberg Business Flash.
What'd you miss? New polls, the first after Monday night's debate, show Democratic presidential nominee Hillary Clinton has taken the lead in 2 key states. Bloomberg politics reporter Sahil Kapoor joins us in Washington with more. Sahil, perhaps not a huge surprise, right? Since she did get good reviews following the debate. And yet we're talking here about Florida. We're also talking about New Hampshire. How surprising is it that we're talking about those 2 states in particular, and how important are they for Hillary Clinton?
They're certainly important. They're two of the most, they will be two of the most hotly contested battleground states in the November 8th election. And I think the reviews are in. It's pretty clear based on the polls we have so far, and we have a lot of them, that Hillary Clinton won the debate in the minds of most American voters. Now, this is very interesting because it wasn't just those two states. We've seen polls from today from 4 battleground states, including the 2 you mentioned, that have shown Hillary Clinton leading Donald Trump. All 4 of them, she's leading Donald Trump. So, Trump is in an interesting position where he has to run the table on the swing states that are available because the Democrats just have an easier path to 270. If this is the beginning of a trend where the race is breaking away in Hillary Clinton's favor, that's very bad news for Donald Trump. But as they say, it's still only September. We have a long way to go, and the winner of the first debate does not always win the presidential election.
So, Hill, when you look at those 2 states in particular, New Hampshire's kind of been the focus because obviously that's a place where she's gotten beaten up pretty badly. But in terms of beating Trump there, I mean, obviously she had trouble with Bernie. But in terms of beating Trump there, is that a huge obstacle that she has to climb, or is it hers to lose, rather?
I think New Hampshire is going to be one of the last swing states to tip. I think if Trump is going to win, there are theoretical ways he has a path to 270 without it. It could be very crucial. It could be very crucial if we're looking, if this goes down the wire, if it goes down the final stretch, and it's decided by 4 electoral votes, which is what's there. I don't think Hillary Clinton's problems in the primary versus Bernie Sanders are going to translate because it's just a vastly different electorate from the Democratic primary to the general election. New Hampshire is a state that's been trending blue for a while. Democrats have won this for the last several presidential elections, even before President Obama won it twice. So I don't think New Hampshire is a big problem for Hillary Clinton at this point, at least.
When we look back to the debate, one of the highlights for the Clinton campaign was, of course, when she baited Donald Trump with her comments, or with his comments, I should say, against the Miss Universe candidate a couple years ago. And Donald Trump has continued to keep that conversation going. He keeps tweeting about it. My question is, to what benefit is it for him to continue talking about this? It clearly was not a flattering remark, but does he have a strategy here, or is this just him not being able to control that impulse to respond?
My colleagues and I spoke to a number of Republican strategists yesterday and today, including many of them that support Trump, and nobody can figure out the strategy here. It doesn't help him to be spending days in a feud with a former Miss Universe winner who he publicly humiliated in the 1990s after she gained some weight. There's no apparent strategy here. I think this is more than anything else about Trump acting on instinct, acting on impulse. Hillary Clinton brought this up in the debate, and she very forcefully attacked him on it, and he's been facing a lot of criticism about it since then. The contestant, Alicia Machado, spoke out about this today. She very forcefully went after Trump. And this has kind of been a pattern with him. He doesn't like any attacks on him to go unanswered, even when there's no clear political benefit to engaging in the conversation. So that's the pickle he's in right now.
But Sahil, there may not be political benefit, but is there harm to him doing this? In other words, the folks who are committed Donald Trump voters at this point, is this going to change their minds? And the folks who are undecided, is this really something that's going to tip the scales one way or the other? What do they care about?
That's a great question. I don't think the Republicans who support Donald Trump are going to be swayed by this. I don't think he's going to lose votes over this based on the base he already has. But Trump doesn't need to simply keep the base he has. He needs to expand his appeal if he's going to win. And the one pot of votes on the table with whom he has potential, with whom Republicans have done well in previous elections, is suburban women, college-educated white women in particular, who tend to vote Republican. And this does not help. This obviously is not going to help Trump with them. They have concerns about Trump's history of sexist comments and sort of insults and demeaning comments about women. So, this certainly doesn't help his case with them. And they're also concerned about his temperament. Hillary Clinton went after him just in the last hour at a rally in Florida and called his Twitter attacks on her this morning a meltdown, called him unhinged. So this kind of plays into her narrative a little bit.
Sahil, great analysis. As always, that's Sahil Kapoor of Bloomberg News in Washington, D.C.
We have some breaking news on this Friday afternoon. Illinois Treasurer Michael Frerichs says that the state will suspend investment activity with Wells Fargo, and he will hold a press conference on the state's plan come Monday. And, of course, we already know that California's treasurer has already suspended Wells Fargo from underwriting state bond issues and from banking transactions. John Chung had said that Mr. Stumpf, the CEO of Wells Fargo, should step down following the disclosure or is it a disclosure? I guess it was a disclosure eventually that they opened 2 million fraudulent bank accounts. We'll continue to monitor these headlines for you. But in the meantime, Wells Fargo not getting any investment activity from Wells Fargo. From Illinois. Excuse me. Thank
Coming
you.
up next, we're going to turn back to commodities. Citi's global head of commodities research, Ed Morse, gives his thoughts on this week's OPEC agreement and whether or not it will affect oil prices in the long term. This is Bloomberg.
We've got some breaking news from Mexico's central bank governor, Augusta Carstens, says that the peso has room to rally and that extraordinary events, including the victory of Donald Trump in November's presidential elections, could trigger an interest rate increase. He did say that the central bank is comfortable with the current monetary policy stance. And, of course, the central bank did raise interest rates earlier this week. Meantime, yesterday, as you know, the world reacted to OPEC's production deal. And according to Citigroup's global head of commodities, Ed Morse, the agreement wasn't all that gripping.
The days of the Saudis playing the central banker of oil are over, adding and retracting liquidity. And part of it's the shale revolution. Part of it is that oil demand growth is unlikely to be as robust as it was in the past. Part of it is that oil has substitutes, challenges from electric vehicles and natural gas. And part of it is that shale and the deep water and the oil sands can be produced, all of them, at a much lower level than what warranted $100 oil in the years earlier in the decade.
So in terms of this specific announcement that we heard from OPEC yesterday, what details need to be spelled out for you to change your price forecast in a meaningful way? You're looking for $40 to $50 a barrel in the second half. That's a trading range, potentially above $50 depending on what kind of winter weather we get here. And Brent reaching, what, $65 by the fourth quarter of 2017?
Yeah, we're sticking by that. We don't think the Saudi agreement with the rest of OPEC has anything to do with the market itself. And the market is, as the Saudis have been saying, marching toward rebalancing. Demand growth in the world is growing. It's positive. It's more than 1 million barrels a day. It could be a lot more than that in the winter if the weather is a lot colder. And meanwhile, non-OPEC production is continuing to slide. The big question on non-OPEC production is not whether there'll be a continued slide in Mexico and Colombia and China, but rather whether we get to a price where U.S. producers can hedge and then start drilling again. And that drilling could lead to, if it's enough drilling, 1 million barrels a day of growth in production in late 2017-18, 2018-2019, and that would keep a lid on prices.
Do we know what that price point is, at which point the shale producers would come and start drilling?
We're in a dynamic period of time, so we know what it used to be, but with efficiency gains and technological changes, that number's going down. So we used to feel comfortable that it was a $60 number, and I think now it's closer to a $55 number. We've had rig counts in the U.S. going up by 107 oil rigs since the middle of the second quarter. Continues to rise. I think we need another 400 rigs to get back to the point where U.S. production growth could really be significant. But meanwhile, creeping up there, adding 10 or 15 rigs to the rig count every week really does have an impact over time.
Yeah, it's incremental, but it certainly does add to it. What will happen between now and November 30th when OPEC meets once again, but on a more formal basis?
Well, they're going to have some internal meetings to try to figure out the targets and whether they can actually negotiate those targets. And, they have in the past negotiated a group target. It would be maybe something they could announce. They talked about a range of 32.5 to 33 million barrels a day. Maybe they'll pick a number and say that's what we're going to produce and not allocate. Or maybe they'll allocate for some countries and say, we know we can't put a quota on Iran maybe, but certainly not Libya, not Venezuela, not Nigeria.
Iran seems to be the big winner here. What did it have to give up? What kind of cost did it have to incur to get the maximum flexibility that it seems to have achieved?
I think Iran being a big winner is an optical illusion. We don't know what Iran is committing itself to. We know that for the Saudis to agree, there has to be some commitment on the part of the Iranians. Is that going to be 3.6, 3.8, or 4.2 million barrels a day? Between 3.6 and 4.2, 600,000 barrels a day is about the scope of the difference between the low point and the high point in the OPEC estimate of where that targeted range might be.
That was Citigroup Global Head of Commodities, Ed Morse. This is Bloomberg. A bit of a relief rally in U.S. stocks as Deutsche Bank shares recover on reports that perhaps it won't have to pay as much as expected to the DOJ. As for next week, don't miss this. China manufacturing PMI coming out actually tonight at 9:20 p.m.
And then on Monday, 4:30 a.m., UK PMI for the month of September, the latest read on the Brexit vote effect.
All right, then don't miss this. We've also got the jobs report on Friday. So that'll be one that everyone always watches.
That's all for What You Missed. Thanks for watching.
We will be back on Monday.